a seriously problematic exchange rate with them. And to look at that and go, okay, well, let's just slash rates. Like, yeah, I bet the governor of the Bank of Canada was sweating a little bit today, for sure, when he had to answer questions, because none of this makes any
100%.
sense.
6 months ago, it's very interesting. Like every economist suggested that the overnight lending rate will land around 3%. Like it should hit 3%. And this was 6 months ago before they started any cuts. Today, we're at 3.25%. Like these last 6 months or 5 months really have been really, really a wake up call to I think like to many people that Canada is not in a good spot. A lot of people are struggling, and it's a pretty loud message from the Bank of Canada to kind of tell us that Canadian dollar, as you mentioned, it's going to continue to free fall. Um, yeah, very like growing unemployment. There's a whole bunch of factors that are going to have this impact, and it'll continue to hopefully to stop spiraling. But everyone was satisfied with the overnight lending rate landing at 3%. So we're 25 bips away from that.
And it's so funny because I remember Tiff Macklem saying over and over again in those meetings, well, it takes between 12 and 18 months to really see the full effect of these interest rate hikes, right? They didn't even get to 18 months of holding before they started cutting aggressively now,
Yeah.
right? So we're seeing them completely just it's like they're in we're all in a sinking ship and they only have 10 fingers to plug holes with, and they're out of
Yeah.
fingers. Welcome to Supply and Demand with Adam Nadler. This is a podcast dedicated to the real estate market in Canada, available now on YouTube, Apple Music, and Spotify. All right, back at it again, Mr. Jeff Mudrick. So tell me what's going on here today because we got a big drop from the Bank of Canada. What's going on?
Well, I don't know. Like we can spin this as positive news, negative news. We can kind of spin it however we want, but just sticking to the numbers are awesome for anybody who currently has a variable rate mortgage, an adjustable rate mortgage, which is another type of variable rate, a line of credit, who needs to bridge financing. Everyone's lives just got much less expensive. Everyone who has that. As we do every time there's a rate announcement, we need to preface by saying anybody with a fixed rate mortgage, this has no impact to you. So you can call your bank or your broker and ask them how much lower your payments are going to be. But sorry to spoil the news that fixed rates, your rate's going to stay the same.
Okay, so what was the messaging from the Bank of Canada? Because we've seen two, half percent drops in the last, let's call it month and a half, which is quite aggressive. Overall, since June, we've seen, what is it, 1.75% dropped from the Bank of Canada. So it seems like they're now kind of scrambling this year to drop very aggressively and very quickly, because it seems like they've overcorrected as usual. And as we've spoken about previously on the podcast, however, this is putting the Canadian dollar in a really terrible spot. So, what was the messaging today?
I would have personally felt a little more comfortable with a 1/4%. Like there's different types of messaging. One, the governor, like the governor Tiff Macklem, who runs the Bank of Canada. I don't know if anyone watched any of the press conference where he was talking and he was answering questions, but the amount of time this person needed to pause, gets a drink of water, like it's worrisome for me to watch that. I don't like the person who runs the banking in Canada to be like on edge on a day when obviously should be prepped to answer these difficult questions. But I think that my thoughts on it are there's if you look at any government, any political party in Canada, any provincial government, everyone is pressuring the Bank of Canada to cut rates. Why do we think that is? Because it benefits the people, like the people who these premiers and mayors who they serve. There's just a ton of political pressure. It's likely going to be an election year next year. And all of that is like, to me, that is why we're seeing such aggressive drops. Not only why, The other thing I wanted to chat briefly about is before last week, every economist out there, I think it was somewhere over 80% of economists were predicting a 1/4% drop this week. What changed last week is we got those lovely unemployment numbers back, and that skyrocketed, scared everyone, including the Bank of Canada. And the belief is that that is kind of what pushed it over the edge to decide what happened today, and ultimately cut the overnight lending rate by 0.5%.
Right. So I think we moved up from what was it, 6.5 to 6.8 in unemployment.
Yeah, which is it's a big jump, and I think it's scary for a lot of people heading into the holidays. Like I think prior to this announcement, the expectation was over the next 13 months, so this was in November, over the next 13 months, the expect most banks agreed they would expect a total of a 1% drop in the overnight lending rate. Well, we're already halfway there and we're not even in the new year yet. So the expectation now is still that 1% between now and the new year, which obviously is going to bode well for anyone with a variable rate. And this is we'll kind of have to hold our breath and see what happens in January.
But I mean, I guess from the real estate perspective, of course, which is always the lens that we try to take here because, that's the industry that we're in. This bodes well for real estate in general to have lower interest rates. However, I mean, there's a lot of other, let's call it unintended consequences that come from this that are not exactly unforeseen and that will affect the real estate market in general because it's affecting our economy. And so when we look at this and we go, well, they're dropping really fast, that's kind of, it's scaring us to know how scared they are because our economy is floundering completely. And now because we're dropping way faster than the United States, our exchange rate with the US dollar is completely plummeting. And that's really, really bad. Well, obviously, because they're our biggest trading partner. We just happen to be next door neighbors with the biggest economic and military power the world has ever seen. For us, plainly put, there is no real other trading partner that we have in that respect. We have these guys. I mean, this is it. This is the engine, the economic powerhouse of the world. So, when we look at this and then we go, okay, well, payments are coming down, but if the dollar starts to crash and burn, and on top of that, we start to get huge tariffs slapped on Canadian goods and services coming across the border, our economy is going to tank, right? We can't keep up business and trade like that with our largest trading partner. We do over half of all of our trading is with them. So how how was that addressed today?
Yeah, I think with the president coming into power in less than a month, I believe now, I'm sure that had some sort of impact on this decision. And you and I have talked about this so many times with the Bank of Canada. What they did during COVID, they overreacted. They kept cutting and cutting and cutting and cutting, which maybe was the right move. Like, okay. But then they held steady for way too long. And then by the time inflation got to where it was, which was I forget what the final, the peak of it was. But by the time we got there, the Bank of Canada didn't really have a choice but to start skyrocketing rates. So we've talked. I remember this conversation. It was you were like the first person I was on a podcast with during slash nearing the end of the COVID times. And we talked, the Bank of Canada overreacted. Now they're waiting too long to react. They're going to have to start hiking. No one really foresaw what the hikes, how quickly they hiked it. But as quickly as they hiked it, they're cutting it right back down. So what messaging are we giving, or is the Bank of Canada giving to variable rate holders? Is it a message of I'm curious to know if anyone who's listening, yourself included, is the message we're giving to those with a variable interest rate, hey, get a variable rate because rates are coming down? Or is it rates might be coming down, but as quickly as they're coming down, they're going to go right back up. So you might want to peak at a fixed rate right now. I'm really curious because this is the trend we've seen for the last almost like 3 years now is cut, 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 increase, and now we're seeing the cuts again, which I agree are needed. But what messaging does that give to us, our politicians, our economy, like with the U.S. and all the things you had mentioned? Like it's a very, I still consider it like a volatile time.
100%. Well, this is, I can only speak as a consumer myself, someone who also has a mortgage. I mean, I have a mortgage, you have a mortgage, right? I can tell you that my feelings as a consumer, just personally, anecdotally, are I've lost. I mean, I didn't have much faith in the Bank of Canada to begin with, but whatever faith I did have in them to actually manage this economy is gone, right? Like they have lost all credibility to be able to steer the ship and do it efficiently and do it effectively. And you know what? That's not exactly a huge shocker, right? And it shouldn't be a surprise to anybody that you cannot centrally plan an economy. You cannot centrally plan the very cost of capital. That is the driving force of an economy, is the actual cost of capital itself. And we all know this, right? We've seen what happens in places like the Soviet Union when they had the pricing czar trying to figure out what the price, not figure out, but dictate what the price of everything is going to be every single day. And this is essentially what we're seeing here, but just to a lesser extent, right? Is they're playing with what they think, the price of capital should be on a 6 week basis every 6 weeks.
Yeah.
And, and looking at the numbers, this is an economic machine essentially, when you really break it down, is a computational problem, right? Because if you think about the word economics, the etymology of the word economics is the study of scarcity. That's what economics means. And when you actually look at that and you say, okay, well, we have the study of scarcity, we have all these different factors, most of which we can't even measure, let alone manage. And we take that and say to ourselves, well, if we were to look at any solution that was a computational problem, is there a there are a couple ways of solving it, and which one is better? We know that there are centralized computational systems, right? Stick it into one computer, or there are distributed computational systems, and that's dividing it among multiple different computers, and let them all vie for computational power. And so that's what an economy is. Every single individual consumer in a free market is its own computational system for value. And that's why free markets are much more um, better equipped and much more efficient at determining value. But here we've, again, just like every other country in the world, have decided, no, we're going to have a central planning committee called the Bank of Canada that's going to decide centrally what the price of capital is. Like, it's ridiculous. Should be left to the free market, and this is why we have these issues, and this is why the credibility is completely faltered, and as it should be, frankly. But I can see
It's
here you want to share something. I'm going to give you the screen 1 second.
So yeah, I was on a call this morning just during the announcement, and it's super like educated economists who are on this call as well and having discussions around what this means for the economy. Essentially, we all knew it was going to be the 50 basis point cut as of really like Monday. It was pretty clear. Um, but they brought up this graph, and I know you're going to have it's going to be something that I think you'll like to see, or maybe not like to see, but um, so let me know when you can see the comparison essentially between Canada and the US.
Yeah.
Can you see? Okay.
Yes.
So before we start diving into the numbers, I just want to say two quick things. One, in 2019, Justin Trudeau was president and Donald Trump was president.
Prime Minister.
2020, sorry, Prime Minister, thank you. 2024, Trudeau is going to be back in power, or sorry, Trudeau is still the prime minister and Trump's going to be back in power. So if we're looking at these variances, yeah, this is now down to 3.25. So we're kind of, as you mentioned earlier, we are cutting much more aggressively than the US is. Unemployment in Canada skyrocketing, inflation in Canada coming down. one thing that we were discussing around this 2.0 number is the fact that if you're taking like the way inflation is calculated, it ton of different factors that are that impact this number. So if you take mortgage interest rate out of this, we're really down to like 1.2 to 1.4 in terms of inflation. So it's very, very low.
Sorry. Okay. So this is an interesting point. I just want to stop you right there for one quick second to discuss that. Every other country in the world, I think aside from
I
Iceland,
think that, oh, okay.
right? I think that's the only one. Um, does not include mortgage payments in their inflation rate calculation because it is directly, obviously, impacted by interest rates. So it becomes a
Which the
circular
Bank of
feedback.
Canada is the like it's
Yeah,
like a
it makes no
yes,
sense because it's a circular feedback loop. If you raise interest rates and you're accounting for that in your inflation rate, then you're essentially saying that the more we raise interest rates, the more inflation is going up, which makes
which is
no
like the whole
sense.
backwards thought of while they were increasing rates, oh, we can't get inflation under control. Well, of course, people are paying X amount of more towards this number. Well, anyways, I can't get into that, right? It's yeah, it's infuriating.
Right. And the
Um,
States doesn't do that. The States doesn't include that in their calculation.
so the bond yields, this is like these are kind of what impact fixed rates. So all gone up a little bit, obviously since 2019, but this is the big one. Look at the amount of debt that it's hard. Like you can't really look at this and be like, oh, it's 800. You know, you can look at the way that I look at it is, as a percentage of what the debt was. So here they've almost doubled their debt. In Canada, we have more than tripled our debt. Or sorry, we've quadrupled our debt. Um, this was the most alarming thing that I saw is holy moly. Like obviously, yes, the US has a lot of debt, but in comparison to where they were 5 years ago, where they've doubled. Whereas we have quadrupled, and this is a very scary, uh, a really scary reality that we as Canadians face.
So this is a really interesting thing for people who are listening right now and not seeing this on YouTube. There's a chart here comparing Canada and the United States between December of 2019, so right before the pandemic, essentially,
And this is of November of 2024. Is
and then column B is November 2024. Now, interest rates have been slashed today, so really we're looking at the interest rate between Canada and the United States was a zero variance in December of 2019. It was both at 1.75. Now it's we're at 3.25 and they're at 4.75, which is a huge difference. Obviously,
which
that's
is
a
historically that's not the case. Historically,
no.
we are pretty much in line.
Yeah, we should be at par with them with about a 1% variance typically at the most. We're at a 1.5% variance, which is big, which is obviously going to tank our dollar's value in comparison. The unemployment rate, just to give everyone who's listening an idea, in December of 2019 for Canada was 5.6% and the United States was 3.6%. Now it's 6.8% for us and 4.2% for them. Inflation similarly was 2.2% for us and 2.3% for them in December 2019. Now it's 2% for us and 2.7% for them. In every respect, when you look at just the basic numbers of inflation, unemployment, and our interest rate, they are doing way, way better than us. Way better than us. Way better. And what we're
And
doing
we're
now,
spending 4 times more in
and
terms
we're
of debt.
and
Like we're yeah.
yeah, and as a percentage of our total GDP, we've quadrupled our debt, right? So Canada's not producing anything. We are going, I mean, we're essentially running jobs out of the country pretty quickly. And what are we doing about it? Encouraging more debt? Like that makes no sense. That's lunacy. That's crazy. That doesn't make any sense whatsoever.
And I think that is also what leads the Bank of Canada to cutting these rates. Like we have to make it a little more attractive to to come to Canada, make it a little bit less expensive because it's very, very expensive right now.
Right. But
Um,
then this is the issue, right? My concern, is you do this, you tank the Canadian dollar. If if Trudeau doesn't, I mean, I know he just went down to Mar-a-Lago to kiss the ring, I guess. And then Trump trolled back with a tweet. Did you see that tweet? It
no, I
was
didn't.
it was pretty funny. He basically said, I was pleased to have dinner with the governor of Canada.
He's pushing for it.
Yeah, yeah. He said Justin Trudeau, the governor of Canada, and basically kind of playing on the fact that Canada should be the 51st state, that they're going to annex us. And to be honest, like you look at the numbers between us and them, and you look at how poorly, I mean, everyone can dig at Trump all you want, but to not also look inwards and take some responsibility as Canadians and go, our economy was so poorly mismanaged, so badly that it's only a half joke to be annexed into the United States to save our economy because we're literally, on the verge or on the precipice of economic collapse with them. If they slap some tariffs on us, our economy's toast, right? And we're already at a seriously problematic exchange rate with them. And to look at that and go, okay, well, let's just slash rates. Like, yeah, I bet the governor of the Bank of Canada was sweating a little bit today for sure when he had to answer questions because none of this makes any
100%.
sense.
6 months ago, it's very interesting. Like every economist suggested that the overnight lending rate will land around 3%. Like it should hit 3%. And this was 6 months ago before they started any cuts. Today, we're at 3.25%. Like these last 6 months or 5 months really have been really, really a wake up call to I think to many people that Canada is not in a good spot. A lot of people are struggling, and it's a pretty loud message from the Bank of Canada to kind of tell us that Canadian dollar, as you mentioned, it's going to continue to free fall. Um, yeah, very like growing unemployment. There's a whole bunch of factors that are going to have this impact, and it'll continue to hopefully to stop spiraling. But everyone was satisfied with the overnight lending rate landing at 3%. So we're 25 bips away from that.
And it's so funny because I remember Tiff Macklem saying over and over again in those meetings, well, it takes between 12 and 18 months to really see the full effect of these interest rate hikes, right? They didn't even get to 18 months of holding before they started cutting aggressively now,
Yeah,
right? So we're seeing them completely just, it's like they're we're all in a sinking ship and they only have 10 fingers to plug holes with, and they're out of
yeah,
fingers.
yeah.
And this is the situation that we're in. So, I mean, not to be so pessimistic, which I can't really help but be right now. Um, I really look at this market and I go, a lot of realtors or people out there who are in the industry are saying like, oh, interest rates are coming down and the market's going to heat up. Da, da, da. It's like it'll take a long time for that to happen. It might, but like there are other factors at play here that are going to affect our economy and that is going to affect our housing market. Like I am not that crazy about this right now.
And the other thing too, I think, is that, the rate announcements that we've seen for the last 5 months, it is good news for anyone with a variable rate who had to endure the higher interest rates what they had years ago. The rate announcement today is not going to have a dramatic effect on the growing unemployment, not going to have a dramatic effect on the huge crash we're seeing in like home starts this year. It's wild. Like the amount of new construction project has fallen off a cliff. Huge issue right now, as you know, with condos throughout the GTA, not selling, just declining in value. And again, because of these like the new starts or construction projects that are not finishing, it's just adding to that decline in manufacturing. Like there's a whole bunch of stuff that this announcement is not going to have a huge impact on right away. But as you mentioned, maybe in 6, 12, 18 months, we see some of this improvement. But well, like again, time will tell.
Time will tell. Well, I thank you so much for taking the time. I know it's a busy one for you. Anytime there's a big rate announcement, I know it's kind of crunch time for you guys over there. So I thank you for taking the time. Um, if anyone has any questions, please feel free to reach out. I'll put all of our, contact info in the description below. Don't forget to like and subscribe. Thanks so much for watching, everybody. See you next time.
See you later.